Welcome back. So today in this module, we're going to talk about comparing an all-cash slow flip purchase to a policy loan purchase and what that means from a financial standpoint. What do the numbers look like? And so for all you spreadsheet nerds out there like myself, your dream is now coming true. So grab some popcorn and let's move in. Let's get into it. All right, first things first. Let's define the parameters. We have a guy named John who's buying who's buying a slow flip at $30,000. Sales price is $79,000. Monthly payment he's receiving from his tenant buyer is $700. And so over the course of 30 years, he essentially receives $252,000 in payments. That's 360 months, 30 years, $700 of payments over that course of that time. We're not factoring in any maintenance, any evictions, none of that, okay? All right, so let's look at what that means. No debt or interest expense. The full $700 comes back to him in the form of cash flow. That also means, though, that opportunity cost is a factor. $30,000 is locked in the real estate, missing out on any potential compound growth elsewhere. Also, there might be a liquidity issue. Cash is tied up for 30 years unless refinanced or resold, okay? Lastly, estate planning considerations. No automatic wealth transfer if John passes. Heirs must handle the asset. Think about that. If you're in a situation, you pass away during your family's grieving process, they're trying to figure out now also having, how do we get rid of this property and just get the money out of this sort of thing, right? They may not be equipped to deal with that. So just consider that as well. Total profit, when we consider 252 minus the original 30,000 in basis, what he contributed is going to be $222,000. Not too shabby. Not too shabby at all. This is how the vast majority of us are doing deals when it comes to self-funding deals. Okay. So, all right. The biggest thing, of course, here is we get all the cash flows and the control element too. No debt. All right. So let's look at a policy loan purchase. In this case, we are taking $30,000. We are borrowing against our own policy, our own banking system. And that comes with a 5% interest rate, which can vary, but 5% is what it's been for, last 15, 20 years. Okay. So $30,000 at 5%, simple interest. We'll talk about that here in a moment, but let's get into how the numbers look. Loan repayment. John repays loan at $566 per month over 5 years. How did I get $566? Well, I used my handy dandy amortization calculator here, and I said $30,000 over 60 months. At 5%. You can determine whatever term you want in terms of how long or how little you pay back. That is completely up to you. But what I'm doing here is I'm mimicking what Scott says, the terms we typically work with when we work with a private money lender. Treat yourself the same. Now, are you going to give back 5% to the insurance company, or 12% that you would give back to a private money lender? That's completely up to you. There's a case to be had. There's an argument to be had that, hey, pay your own banking system back to 12%. And I wholeheartedly agree. Why not pay back your own banking system at a higher rate? Because it's all coming back to you anyway. Treat yourself like the bank. But in this case, I'm going to say the 5% is what the insurance company requires. And so therefore, we're going to charge ourselves 5% over a 60-month period. You see here, over that 60-month period, we've paid back $3,968 in interest and the original $30,000 in principal. This interest does make its way back to us indirectly via the dividend, okay, the profits of the insurance company. So understand that's getting back to us some way, shape, or form. It's just, yes, that is a required part of the purchase. You can decide to stop making payments if something happens. No one's the wiser. It doesn't show up on a credit report. It's completely private, okay? The insurance company gives you a ton of flexibility here. Okay, with that said, $566 is the amount that you're paying to the insurance company over 5 years. You're committing to that, and that's what you're going to do. And so 700 minus 566 is 134. 134 is your cash flow for the first 60 months. 134 is your cash flow for the first 60 months. We talked about the amount going into the insurance company for interest. And so when we take 566, this actually should be 134. 134 times 60 plus 700 times 300 is going to give us 218,040. 218,040. Again, this should be 134. That's what I did the math around. And I'm going to check that right now. Yep, that math checks out. This is 134 times 60 plus 700 times 300. Again, 700 is once we've paid off that policy loan within the policy, we get the full $700, and we multiply that times the remaining period. 25 years or 300 months gives us 218. Okay, so not quite the full price purchase, but we're close. We're close. What are we missing here? Glad you asked. The future value of that 30K. Remember, 30K was sitting in the policy because we borrowed against it. And because of that, that's growing at a conservative 5%, tax-free. So what that equates to over a 30-year period is $129,658. $129,658. When we add up $129,658 plus the 218, okay, gives us $347,698. $347,698. So when we look at this all together, okay, cash up front, $30,000, policy loan purchase, $0. We borrowed against the policy. We like that. We want to not put anything of our own money inside the policy. All right. Monthly loan payment, $0 because it's all cash purchase. This one's $566, okay, for 60 months. Net cash flow, $700. This one's $134 for the first 5 years, $700 for the last 25 years. Total interest, $0. Total interest here, almost $4,000, but recaptured to the policy, and again, it makes its way back to you in the form of a dividend, okay? Opportunity cost in 30K, lost, cash and real estate. This one continues growing tax-free inside the policy. We saw that to the tune of $129,000 over 30 years, okay? Total profit, $222. Total profit here, $347. $347. That is a 56% increase over $222. I'll take that. What could you do with an extra $120,000? Okay, I've got some ideas. All right, liquidity, cash is tied up. Here, can always access cash value for future deals. Okay, control over financing, no loan needed. Here, no bank, no credit check, instant access. All right, estate planning benefits, property only. Here, heirs receive a tax-free death benefit. All right, again, your heirs don't have to deal with managing a property when they're getting the tax-free death benefit to take out any sell those properties and just take the money. Okay. One thing I'll add here is that this is still very conservative. Why? Because what I assumed here is that $700 would not be going back into the policy. In other words, this $700 is going right back into your hands or into the bank. What if this $700 went into a place earning 5%? I am not going to do the math here, but just know it's ridiculous. And if I put the math here, it will look a little bit too unreal. So I decided not to. But understand that this assumes $700 is going back into your hands, back into the bank, and not back into the policy. Okay. Otherwise, if it went back to the policy over a 30-year period, this would be a lot higher. All right. So with that said, key takeaways. All cash purchases give higher immediate cash flow, okay? Policy loan purchases reduce monthly cash flow but preserves the capital, okay? Tax-free loan access and liquidity advantage, and then long-term interest recapture. Okay, we talked about that. That $4,000 isn't lost to a bank. It remains in John's financial system. Final decision. If John wants to be a little bit short-sighted and wants to maximize monthly cash flow, all cash purchase is better. If John wants a multi-dimensional approach, wants a force multiplying effect on every dollar he puts in for long-term liquidity, tax advantages, compound growth, and a death benefit, then the policy loan strategy wins, hands down. With that said, when you control your income, you control your outcome. I look forward to talking to you again in the next module.